Hey everyone, I know Disney stock is down considerably off its highs, and that has many investors asking what's going on with Disney stock. So I made a brief video highlighting the big picture, what's going on with Disney stock that I wanted to share with you today. So let's get right into it. Starting with Disney CEO Bob Iger highlighting that the first round of the NBA playoffs was the most watched ever across Disney networks. They've been averaging 5 million viewers in the first 22 games, which is up 15% compared to the same time last year. Now, why is that critical? Because Disney's linear networks, the cable channels, are the most struggling part of its business. People are canceling cable subscriptions and moving to streaming instead. But one of the things that's keeping people on the cable networks is the sports programming. That's really the only place where you can get live sports programming like the NBA, where you cannot get that on any other streaming service. You can't get it on Netflix, you can't get it on ESPN Plus as much as you can get it on a cable subscription. So this is big news. This should help slow down that bleeding of subscribers from Disney's cable segment, which is so incredibly profitable for Disney, and give it more time to transition into a streaming first company. Additionally, since Disney CEO Bob Iger has came back to the company just a few months ago, he has implemented a massive cost-cutting campaign, and they are on track to meet or exceed that target of $5.5 billion in savings. That's going to be huge. I think the previous CEO, Bob Chapek, overinvested in growth projects, namely in the streaming segment. I think there was overinvestment in that category. So I think rationalizing some of these costs will be good news for Disney stock investors going forward. Disney CEO Bob Iger also highlights that over 40% of their domestic advertising portfolio is addressable, including streaming, which we will expect to continue to grow over time. Let me highlight why this is important. And this is one of the reasons why, if you've been following Meta Platform stock and the other social media stocks like Snap and Pinterest, those stock prices, although Meta has recovered significantly off its highs, they're not doing as well as they were, let's say, 2 years ago. One of the main reasons they're not doing as well as they did 2 years ago is because Apple implemented privacy policy changes on its electronic devices that makes it harder for those social media companies to gather data and sell targeted advertising. Targeting advertising is key because marketers are more interested in spending money on ads if they can target those ads. They want to be able to target ads to people that are likely to be customers. Marketers, let's say you own a steak restaurant in Los Angeles, California. You don't want to show an advertisement to a vegetarian who lives in Miami, Florida. That's just wasted spending, right? So if you can target your advertisement to people that are likely to be customers, you reduce that waste and you get a better return on investment. That's why targeted, addressable advertising is so critical. And Disney, while it's transitioning away from the cable delivery method to the streaming delivery method, is going to have a greater degree of addressable advertising inventory to sell, which is good news for Disney stock investors in the long run. Although the near term transition from a cable delivery to streaming delivery content is going to be choppy and messy, longer term, I think it benefits Disney. Speaking on that matter, Disney plans to launch the ad version and ad tier of Disney Plus in Europe by the end of this year. So in North America, in the US, you can buy an ad-supported version of Disney Plus at a lower price point that's not yet available in Europe. So Disney is going to launch that at the end of this year. That will help it attract subscribers because it's lower prices, and it will also increase Disney's inventory of this addressable advertising. And I'll end with this final note here that the pricing changes they've implemented have already proven successful, and they plan to set a higher price for the ad-free tier later this year. So Disney launched their streaming services at introductory prices when they first came out around 2019. Now they've begun raising prices to start to focus on profitability instead of focusing on subscriber growth, which is going to be solid news for Disney stock investors. It's going to reduce the losses in the streaming segment and turn them into profits, what management says in 2024, expected in 2024. Okay, so I hope I've highlighted a lot of big picture items about what's going on with Disney stock. If you want deeper analysis, I've got a lot of videos on Disney on my channel, so dig around and look for the videos that interest you. And I will be making more videos on Disney stock in the near future. So thank you so much for watching, and I hope I'll see you soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.